Jake buys whole life insurance. Marcus buys term and invests the difference. They both think they made the smarter choice. They are both wrong about why. And when you run the numbers at year 5, year 10, year 20, and year 30, the gap between them will force you to rethink every conversation you have ever had about life insurance. Let's keep this fair. Jake and Marcus are both 30 years old, both healthy non-smokers. Both earn $65,000 a year. Both have a wife, one kid, a mortgage, and the same reason for walking into an insurance conversation in the first place. They want their family protected if something happens to them. Same fear, same starting point, same $500,000 death benefit in mind. The only difference is what they sign at the end of that conversation. Jake signs a whole life insurance policy, $500,000 death benefit. His monthly premium is $450. The agent explains that part of that premium builds cash value over time, a savings component that grows tax-deferred that Jake can borrow against that will be there for him in retirement. The agent calls it permanent protection with living benefits. He draws a chart on a whiteboard showing Jake's cash value climbing steadily upward over 30 years. He uses words like guaranteed and legacy and asset. Jake leaves feeling like he bought something real, something sophisticated, something his friends who just have term policies do not have. Marcus buys a 30-year term life insurance policy, same $500,000 death benefit. His monthly premium is $35. He takes the $415 difference and puts it into a total stock market index fund every single month without fail. His financial advisor calls it buy term and invest the difference. Marcus calls it math. He leaves feeling like he made a sensible, boring decision. He does not have a story to tell. He has a spreadsheet. On day 1, Jake has a policy with a savings component, a guaranteed death benefit, and a product that sounds sophisticated at dinner parties. Marcus has a policy that expires in 30 years and a brokerage account with $415 in it. Nobody is impressed by Marcus at dinner parties. But dinner parties and spreadsheets are two very different things, and over 30 years, spreadsheets win almost every time. For the first few years, Jake feels like he made the premium choice. Every statement he receives shows a cash value balance growing inside his policy. By the end of year 1, his policy has accumulated roughly $1,200 in cash value. By year 3, it is around $4,500. The agent told him it compounds over time, and it does. Slowly, but it does. Jake can see a number growing that belongs to him. He can call his agent and ask about it. He gets a real answer with a real dollar figure. That feels like something he can hold on to. Marcus does not feel much of anything in the early years. He is putting $415 into an index fund every month and watching the market do what markets do. It goes up, it goes down. It goes up more than it goes down. By the end of year 1, he's contributed $4,980, and his account is worth approximately $5,225, assuming a 10% average annual return. By year 3, he has contributed $14,940, and his account sits at roughly $17,400. There is no agent sending him congratulatory statements, no one calling to check in and remind him what a great decision he made. Just a number on a screen and a calendar reminder to not touch it. Here's what Jake doesn't fully understand yet. In the early years of a whole life policy, the vast majority of his premium is not building cash value. It's covering 3 things: the cost of insurance itself, which is the actual risk the company is taking on by agreeing to pay out $500,000 when Jake dies; administrative fees, which cover the operational cost of maintaining a permanent policy over decades; and agent commissions, which are the largest cost embedded in the product and the one nobody talks about at the point of sale. Those commissions on a whole life policy are not small. In the first year alone, the agent who sold Jake his policy likely earned a commission equal to 50 to 100% of Jake's annual premium. That's somewhere between $2,700 and $5,400 paid entirely out of Jake's premiums before a single dollar meaningfully accumulates in cash value. In years 2 through 10, the agent continues to earn trail commissions, typically 5 to 10% of the annual premium. Jake does not see any of this itemized on his statement. He just sees the cash value number, which is always much smaller than the total premiums he has paid in, and much smaller than he expected when he signed. This is the first hidden cost. It's not the last. The insurance industry has a name for the period in which your cash value is dramatically lower than your total premiums paid. They call it the surrender charge period. If Jake decides in year 3 that he made a mistake and wants to cancel the policy and take his cash value, he doesn't walk away with $4,500. He walks away with whatever remains after surrender charges, which in the early years of most whole life policies can reduce his payout to nearly zero. Some policies have surrender periods lasting 10 to 15 years. Jake is not just locked into a premium, he's locked into the product itself. Exiting early is expensive by design. Marcus has no surrender period, no exit penalty. If he decides in year 3 that he wants to change his investment strategy entirely, he sells his index fund shares, pays standard capital gains tax on the growth, and moves on. The friction is minimal. The control is his. Year 5 Scoreboard. Jake has paid $450 a month for 60 months. Total premiums paid $27,000. His cash value at year 5 is approximately $14,000 to $16,000, depending on the policy's dividend performance. His death benefit remains $500,000. If he called his agent today and asked what he would walk away with if he surrendered the policy, the answer would be somewhere between $10,000 and $13,000 after surrender charges. He paid $27,000 to access $10,000 to $13,000 in 5 years. That's the reality of early whole life ownership that the whiteboard chart never showed. Marcus has paid $35 a month for his term policy. Total term premiums paid $2,100. He has invested $415 a month for 60 months. Total invested $24,900. At a 10% average annual return, his portfolio is worth approximately $32,000 to $34,000. His death benefit remains $500,000. If Marcus died today, his family would receive $500,000 from the term policy, plus roughly $33,000 from the investment account. Total family protection, approximately $533,000. If Jake died today, his family receives $500,000. The cash value does not stack on top of the death benefit in a standard whole life policy. It's already factored in. Jake paid $27,000 over 5 years for the same $500,000 death benefit that Marcus secured for $2,100. The gap at year 5 is already significant. But the agents who sell whole life policies know this, and they have a prepared response. The response sounds like this. Markets crash. In 2008, the stock market dropped 37%. In early 2020, it dropped 34% in about a month. Marcus watched his $33,000 account fall toward $22,000 on paper and had to fight every instinct telling him to sell and stop the bleeding. Jake never had that conversation with himself. His cash value statement didn't change. His guaranteed growth kept accumulating. Stability and guarantees have real value that a market return chart does not capture. That's a legitimate argument. It deserves a legitimate answer. The answer lives at year 15, year 20, and year 30.
Understanding the policy loan trap. One of the most heavily marketed features of whole life insurance is the ability to borrow against your cash value. The agent calls it your personal bank. The pitch is compelling. You need $20,000 for a home renovation. Instead of going to an actual bank and paying interest to a lender, you borrow from your own policy at a low interest rate and pay yourself back. The interest you pay goes back into your own account. You are your own bank. Here is what that pitch leaves out. When you take a policy loan, the insurance company does not actually take money out of your cash value account. Your cash value remains intact and continues to grow as if you never touched it. But the company lends you money from their general fund, using your cash value as collateral. The loan accrues interest. If you do not repay the loan, the outstanding balance plus accumulated interest is deducted from your death benefit when you die. So your family does not receive $500,000. They receive $500,000 minus the unpaid loan balance. If Jake borrowed $30,000 at year 15 and never fully repaid it, and interest has compounded that balance to $45,000 by year 30, his family receives $455,000, not $500,000. The personal bank concept is real, but it requires discipline and active management that the sales pitch does not emphasize. Most policyholders do not repay policy loans in full. Most policyholders do not fully understand how unpaid loan interest compounds against their death benefit, and the insurance company does not send urgent warnings when this is happening. They send annual statements with numbers that require careful reading to fully interpret. Marcus does not have a personal bank, but he has a brokerage account worth $33,000 at year 5 that he can access within a couple of business days. He pays capital gains tax on the growth. That is his cost of access. No interest charges, no death benefit reduction, no collateral requirement. Just his money, accessible on his terms. Year 10 Scoreboard. Jake has now paid $54,000 in total premiums over 10 years. His cash value is approximately $38,000 to $44,000. The growth curve has steepened noticeably. The early drag from commissions and surrender charges has diminished. The policy is finally beginning to behave more closely to how the agent described it at the point of sale. Jake is feeling more patient about this. The long game is starting to show. He can borrow against $40,000 in cash value if he needs to. His death benefit is intact. He has permanent coverage that will never be canceled as long as he keeps paying premiums. For a 40-year-old man who has watched colleagues get diagnosed with serious illnesses that would make them uninsurable, that permanence feels increasingly valuable. Marcus has paid $4,200 in term premiums over 10 years. He has invested $415 a month for 10 years without interruption. Total contributed to his index fund $49,800. At a 10% average annual return, his portfolio is worth approximately $85,000 to $90,000. He did not pick individual stocks. He did not time any market moves. He did not react to a single headline. He just kept depositing $415 every month and let compounding do the work that patience allows. The gap at year 10 is no longer merely uncomfortable. It is a full separation. Marcus has roughly twice Jake's accessible cash value, while having spent significantly less in total premiums. His family protection, the term death benefit plus the investment account, now totals approximately $585,000. Jake's family protection is still $500,000. But there is a complication that most YouTube videos about this topic are too dishonest to mention. Jake's cash value at year 10 is guaranteed. It will not fall. It is not subject to sequence of returns risk. If the market crashes the month before Jake retires, his cash value does not crater the way Marcus's portfolio might. For someone approaching retirement with a large concentration of assets in the market, that guaranteed floor has real strategic value. Hold that thought. Year 15, the inflection point nobody marks. By year 15, something is shifted in both stories in ways that are not visible on a simple comparison chart. Jacobs has paid $81,000 in total premiums over 15 years. His cash value is now approximately $80,000 to $95,000. For the first time, his cash value is approaching his total premiums paid. The policy is no longer obviously underwater from a pure cash perspective. Dividends, if his policy is a participating whole life policy from a mutual insurance company, have been accumulating and compounding. His death benefit may have